Physical Gold Fund presents the Gold Chronicles with Jim Rickards. Insights and analysis about economics, geopolitics, global finance, and gold. Welcome to part 3 of the latest podcast from the Gold Chronicles with Jim Rickards, presented by Physical Gold Fund.
There is really a huge number of questions that we've got in the queue, and we're not going to be able to answer them all, but we will pick out a couple and go over them. We've got about 20 minutes left, so that being said, we'll just dive right into these. First, I want to quickly provide a little bit of background information for this next question. Jim, as you know, the Summit of the Americas is being hosted here over the next couple of days in Panama. There are over 30 presidents from the Americas that are arriving here for this summit. What's different about this is that we've got the presidents from Cuba, President Castro, Maduro from Venezuela, and Obama are all going to be in the same room at the same time. This is the first thing, as far as we know, first time this has happened in the last 50 years. The streets are pretty much all shut down. There is a U.S. warship in the Bay of Panama. There are U.S. military vehicles on the street corners. There's military attack helicopters flying overhead, and Air Force One is expected to fly in sometime today. So the question is, and this is coming from Philip, do you feel that this America's Summit has any bearing on Russia, Venezuela, or the Russian-Cuba relations? And does this in any way signal a shift of U.S. foreign policy in regards to the Americas?
I think it does, Alex. It's a great question. My last visit to Panama, I was able to enjoy some fine club activity in the, I think it's called the Ciudad Viejo, if I'm not mistaken, the old city part of Panama, and enjoy some nice contraband Cuban cigars. But I'm glad I'm not there now because I imagine it's difficult to move around, even though it is a beautiful city. But this is a very big deal. You know, go back to the election in 2014, the U.S. Midterm elections. And, of course, you know, the Republicans already had the House of Representatives. They increased their seats in the House of Representatives. They took control of the Senate. And a lot of analysts and Republicans in particular looked at this and said, you know, aha, you know, this is a turning point. Finally, Obama's, you know, painted into a corner, if you will. This is going to trim his sails a little bit in terms of his ability, his degrees of freedom to act. In fact, what's happened is quite the opposite. Obama is, you know, unleashed, if you will. He's looking at his administration saying, well, now I can do whatever I want. And that seems paradoxical, but not really, because as long as the Democrats controlled the Senate, he sort of had to work with the Senate Democrats and Harry Reid. He couldn't just ignore his own party's majority in the Senate. So it was a three-way conversation among House Republicans, Senate Democrats, and a Democratic White House. But once the Republicans took the Senate, the president doesn't have to talk to them at all, and he doesn't. So he's just doing whatever he wants. And so the president's feeling very strong, whether it's detente with Iran, you know, poking a stick in Netanyahu's eye, you know, relaxing sanctions with Cuba, and that actually seems to be moving on a faster track. Obviously, these things don't happen overnight, but that's moving very quickly. And now with Maduro in Venezuela, and, you know, what better opportunity than the Summit of the Americas that you just described. So the president, and of course traditionally, not just traditionally, but legally, the president does have more degrees of freedom in foreign policy. So I think we're looking at, you know, normalization of relations with Cuba, warming of relations with Venezuela, and this is sort of a bigger picture thing. I think you put your finger on it, Alex, with the questioner did, in terms of peeling away Russia's influence in the Western Hemisphere. But Russia's not really the problem in the Western Hemisphere. I mean, that was true in the 60s and 70s, from you know, Bolivia to the Bay of Pigs. But Russia's focus is on the Russian periphery, reestablishing the old Russian Empire, Eastern Europe, Central Asia. Russia doesn't care that much about the Western Hemisphere. Or maybe they care, but they don't have the capacity to do very much, and it's not Putin's interest at all. So peeling Venezuela away from Russia, you know, it's probably a win for the United States, but it doesn't mean very much to Russia. The real player is China. China is, you know, obviously actively studying a new an alternative. First of all, China has a lot of influence in the Panama Canal and the Canal Zone, as you know. China is actively looking at building a new canal in possibly Nicaragua. Now, that's a multi-year multi-$10 billion project, and that's been talked about for over 100 years, going back to before the Panama Canal was built. So let's see how that plays out, but that's something China's interested in. China's interested in buying Venezuelan oil and swapping it for other oil that arrives in China and send the Venezuelan oil to the Virgin Islands or the Gulf Coast. Venezuelan oil is very undesirable. It's heavy, it's sulfurous, it's kind of the bottom of everyone's list, but it is oil at the margin, and Venezuela certainly needs the money. So look, I think the president is, probably just, this is probably just unfinished business from the Cold War. Why shouldn't the U.S. have, closer relations with Cuba and Venezuela? But Russia is not really the issue any longer. It's China. And I think, you can win the battle and lose the war, so we've got closer relations with Cuba and Venezuela, fine. We've lost Latin America. I mean, I happen to be, before I went to law school, was actually an international economics and Latin American studies grad student at the School of Advanced International Studies in Washington, and my thesis advisor was Reardon Rowett, who to this day, and I studied with Reardon 40 years ago, but to this day Reardon is very active and the leading scholar of Latin America, and the #1 U.S. expert on Brazil. I mean, he's a legend in Latin American studies circles, and Reardon considers Latin America a Chinese sphere of influence. So just go to get down to Santiago or Lima or Ecuador or Argentina and look at the swap lines, look at the trade lines, or certainly Brazil. Obviously, China has really taken over Latin America without firing a shot. So not much left of the Monroe Doctrine. So chalk up a win in Venezuela, but maybe more importantly, we should chalk up a loss for the U.S. sphere of influence in Latin America, because it's now a Chinese sphere of influence.
Okay, so the next question we have here is coming from Francis F. This question came in by email. He says that Jim has said the entire world's got the same problem when it comes to debt, deflation, and inflation. He says, I live in Ireland, and apart from low inflation, the country, according to the national media, is supposedly on an accelerating recovery, which to me sounds like every other country around the planet. In your view, are these false promises and hopeful thinking, or real economic expansion? And he, by the way, he has a PS on here. He says, I was recently 33% in precious metals, but cut back to 26% and regret it because now he's in euros.
Well, I can't, not much I can say for the latter. As you know, Alex, I've pretty consistently recommended 10% gold for the conservative investor, 20% for the aggressive investor. I have, consulting clients who are 50% in gold, and I say, fine, you didn't get that from me. I think 50% is way too much, 33% is way too much. But of course, the point is, institutional allocations around the world are about, as you know, about 1.5%. So even if you took my conservative recommendation of 10%, or you cut that in half to 5%, that's still more than 3 times what institutions actually have in gold. And if institutions even tried to move from the 1.5% to the 5% level, when we're talking about trillions of dollars of wealth around the world, I mean, the impact on the gold price would be incalculable. That would get you, way past $2,000, probably in the $3,000 to $5,000 per ounce range, on its way higher, because at that point it would be a disorderly route in favor of higher dollar gold prices. So 10% isn't, that's my recommendation, but that's 5 or 6 times what institutions actually have today. So not a lot of headroom if there was a shift to gold. But as far as the euro is concerned, if it's any consolation, it's probably at a low. But let me come back to the listener's question, which is, look, there's real growth in Ireland, no doubt about it. There's real growth in Spain, there's real growth in Europe. But I think the bigger picture is there's insufficient growth around the world. The world as a whole does not have enough growth to go around. And we're going to see that's clearly in the data, but we're going to see confirmation of that next week when the International Monetary Fund at their spring meeting. Washington is going to update the World Economic Outlook. They marked it down last September. They do this twice a year. They marked it down last September. My guess is they'll probably mark it down again next week. China's slowing down visibly. The U.S. has fallen off a cliff. We had 5% growth in the third quarter of 2014, which was phony for some accounting reasons having to do with the election, but it dropped to 2.2% in the fourth quarter. It looks like it's coming in way below 1%, maybe even 0 in the first quarter of 2015. I don't see that picking up. So U.S. growth has fallen off a cliff. Chinese growth is rapidly slowing down. Europe's picking up. But why is that? Well, it's the currency wars. It's the same old story. Go back to 2010. The guy with the cheap currency gets temporary growth. That is true. When Barry Eichengreen and Paul Krugman and people like that, Stiglitz and others come out and say, cut your currency, you'll get some growth. It's true in the short run, but all you're doing is stealing the growth from somebody else. You're not doing anything for global growth, and you're hurting your trading partners. So my analogy or metaphor is, you got 4 or 5 thirsty soldiers on the battlefield. They've been fighting all day, hand-to-hand combat in 110-degree heat. They caught a break and they've got one canteen. So what do you do in that situation? Well, you pass the canteen. Everybody takes a drink and hands it to the next guy, and people try not to be too much of a pig and drink too much of the water. That's the best you can do. Well, that's one way to understand global economic growth. In 2011, when the dollar was at a long-term low, and gold was at its all-time high. By the way, the dollar and gold are just inverse to each other. So 2011, August 2011, dollar's at a low, gold's at a high. That was the U.S. holding the canteen drinking, but the U.S. said to the world, hey, we need the growth. If the U.S. doesn't grow, the rest of you are sunk. We're all sunk. And so give us a chance. But by 2012, 2013, it looked like the U.S. was growing more strongly. Of course, it wasn't really. That was just based on bad Fed forecasts, but they thought it was. That's when Bernanke did the taper talk in March 2013, started the taper in December 2013. Janet Yellen finished the taper through November 2014. That was the U.S. handing the canteen to Japan and Europe. Japan got the first drink, in December 2012 with Abenomics. They trashed the yen. The yen went very quickly from 90 to 120 or so. Then they passed the canteen over to Europe. They trashed the euro. The euro went from, roughly 135 to 105, somewhere in that band very quickly. These are huge swings. I mean, you look at the history of foreign exchange trading. Foreign exchange is a market that's traded at the 5th decimal place. When you talk about 103 euros to the dollar, I mean, the quotes are like 103.12345. I mean, this is stuff that trades at 5 decimal places, and you move it, you bang it 30% in 6 months. That's an earthquake. And so that's what happened to the euro, but it was past the canteen. So yeah, Ireland's growing, Spain's growing. That's good for them. Germany is picking up all the pieces, but it's coming at the expense of China and the United States. Well, how long is that going to last? How much stronger can the dollar get before we go into recession? The answer is not much. The question is there a bigger play here? Are we converging on something that starts to look like, what happened in the mid-1980s when at the Plaza Accord and the Louvre Accord? Well, let's watch that space. But I would see the euro kind of at a low here. Look, if it goes down a tick tomorrow, don't call me up and tell me I'm an idiot. I mean, these things are volatile. They overshoot. It could go lower. But I see the euro at the low end of a range. I see the dollar at the high end of a range. I see the yuan as sort of joined at the hip with the dollar. They're trying to suck it up and deal with a strong currency, but that's part of getting into the club that we talked about earlier. These are very big plays. The ravens of finance, as I call them, are working behind the scenes. This isn't conspiracy theory. This is how the system has always operated under what I call the rules of the game in my book, The Death of Money. So watch the space. But, and gold is showing a lot of strength. I mean, people say, well, why isn't gold at, $1,400, $1,500 an ounce? Well, the better question is, why isn't it $900 an ounce? Commodities have fallen off a cliff. Deflation's got the upper hand. Growth is slowing down. All those things which say that gold should be lower. But the fact that it's hanging in, that's separated from the commodities index, is hanging in at $1,200 an ounce, to me looks like strength. And so if the dollar's at a peak and is going to start to come down, and gold has weathered the storm vis-a-vis deflation, that's a kind of a bullish signal for gold, and we could see some pleasant surprises for gold investors there between now and the end of the year. So interesting things going on, needless to say.
Okay, I really love the analogies you gave there, and I think that's probably one of the reasons why so many people find what you have to say appealing, Jim, is because you often are able to take very complex issues and boil them down into very simple ways for people to understand with your analogy. So that's really great. Next question is coming from Harry B. And the question is, deflationists say that cash is the go-to asset first and that gold comes after a multi-year deflation. Do you see this playing out differently?
First of all, I wouldn't say that cash is the go-to asset for deflation. I definitely recommend cash in a portfolio, and a significant piece, maybe 30% or so. By the way, interestingly, Mohammed El-Arian, who was by all accounts one of the savviest investors in the world, I mean, he ran Harvard Endowment, he ran PIMCO, so he's an inner circle member of the International Monetary Elite, so not too many people know more about this stuff than El-Arian. He gave an interview to Bloomberg recently. He said he's mostly in cash. Warren Buffett has $55 billion in cash, the most cash he's ever had. So cash is definitely a place to be in deflation, and an allocation of 30% cash or so to me makes sense in this environment. The value of cash does go up in deflation. It is a deflation hedge. But it has other features. It has huge optionality. If you get some more visibility, you can pivot, use the cash to scoop up assets, which no doubt is what Warren Buffett plans to do. And also, think of it as the opposite of leverage. Leverage will increase the volatility of whatever else you have. Cash will decrease the volatility of whatever else you have. So in a volatile world, cash will help you sleep at night. But it's not my go-to inflation play. My go-to inflation play are U.S. Treasury 10-year notes. They're still yielding. Yield to maturity is just under 2. German yield to maturity is around 0. Well, something's wrong there. Either Germany's too low or the U.S. is too high. And based on everything I see, I would say the U.S. is too high. And so if U.S. rates, we have to get to negative real rates to get the economy moving. But negative real rates are a world where inflation is higher than nominal rates. Nominal rates is the rate you actually get when you buy it, and the real rate is inflation minus the nominal rate. Well, you have to get inflation above the nominal rate to get to a negative real rate. Well, what's been happening, of course, is that inflation's dropping, and so the nominal rate has got to chase inflation down to even try to get to a negative real rate. It might just chase it below 0 at the rate things are going. But that's already happened in Europe. It has not quite happened in the United States, but it's happening, and there's this little geeky, but there's something called the DV01, which is the dollar value 1 basis point change in the yield to maturity in terms of the impact on the price. Well, the DV01 goes up at lower absolute levels of interest rates. So when you move from 2% to 1%, your capital gain is much greater than if you move from 10% to 9%. Moving from 10% to 9% is the same 100 basis point change in yield, but the capital gain at lower rates is much greater. So moving from 2% to 1% or 1% to 1.5% produces huge capital gains for the holder of 10-year notes, and that's kind of what I see happening. So I like 10-year notes for a slice. That's my go-to trade for deflation. Cash absolutely has a place. And the question was, gold can do very well in deflation, but only at the end game, meaning when all else has failed. So what do I mean by all else? Well, you cut rates to 0. You did QE1, QE2, QE3, Operation Twist, currency wars, forward guidance, helicopter money. You tried everything, and you still didn't get the inflation you want, and now you have deflation, persistent, significant deflation, meaning 3-4%, something of that order of magnitude. Well, you can always get inflation. I can get inflation in 15 minutes. All the Fed has to do is go into a room, take a vote, walk out 15 minutes later, and announce that the price of gold is $5,000 an ounce, and they'll use the gold in Fort Knox and the market maker banks to stand up to the market. They're a buyer at $49.95, a seller at $50.50. Come and get it, or sell us your gold. But either way, that's the price. And so that's how you get instant inflation. It's not hard to do. This is what the United States did in 1933. But you're not going to get there until the end game. Now, the problem is you can't just put a stake in the ground around deflation. Inflation is an equal opportunity outcome with $4 trillion of money slashing around. We don't have much inflation now, but that could happen almost overnight. We've seen that before in, obviously in Weimar Germany, and something similar, not quite as extreme, started to happen in the United States in the late 70s until Paul Volcker snuffed it out. So to me, the optimal portfolio is ready for both outcomes. So you're going to have some gold for inflation. You're going to have some gold for extreme deflation. You're going to have some cash for lower volatility and deflation. You're going to have some 10-year notes for deflation. I might like some other trades, some venture capital or hedge fund selections, fine art, and some other things for alpha. So, just don't be monocausal. Don't put all your eggs in one basket. That's obvious, but it's never been more important than today, where the threats to the basket are coming from multiple directions. So I do think this mix of gold, cash, 10-year notes, some alternatives, some fine art, some equities is the right way to go. One of the surprise outcomes could be, my view is the Fed's going to blink later this year, probably September, and not only not raise rates, but maybe even drop a hint or two, show a little leg around QE4 early next year. If that happens, the stock market's going to scream. The stock market's going to go way up really quickly. On the other hand, if the Fed actually raises rates, which they've threatened to do ad nauseum, that's going to sink the stock market. So I can give you two really completely plausible scenarios. One, under one scenario, they raise rates and sink the stock market, and the other one, they blink and stock market goes to the moon. So how do you invest in that environment? I mean, both of those scenarios are plausible. That's not me throwing up my hands and saying I don't know what's going to happen. That's me telling you that those are equally plausible outcomes. You better be ready for both.
Okay, that was really good. We have still a ton of questions, and some of these are really great questions, and I wish we had time to ask them, but we're out of time. So with that said, thank you very much, Jim. Thanks to all our listeners. I'm going to hand this back over to John.
Well, thank you, Alex. Let me remind our listeners that you can follow Alex Stanczyk on Twitter. You just go to Twitter and type in Alex, then Stanczyk. Great insights. Valuable links to follow there. And thank you, Jim Rickards. Always a pleasure and an education having you with us. Thank you most of all to our listeners.
Thanks, John.
Of course, you can also follow Jim on Twitter. His handle is @JamesG.Rickards. And let me remind you that you can find recordings of all the Gold Chronicles webinars with Jim Rickards online. Just visit the website physicalgoldfund.com/podcasts and register for updates. So goodbye for now, everyone, and we look forward to joining you again soon. You have been listening to The Gold Chronicles with Jim Rickards, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of upcoming interviews with Jim Rickards and other world-class thinkers.